Welcome to this explainer. Today, we're diving into the absolute collapse of the Canadian dollar we saw this past week. If you trade Forex, do any cross-border business, or honestly just keep an eye on global markets, you know we just witnessed a pretty seismic shift. The Canadian dollar, affectionately known as the loonie, didn't just dip, it absolutely plummeted. So we're going to dig right into the hard data to figure out exactly why this happened. We're essentially going to treat this like a macro autopsy. First, we'll do a quick weekly overview of the Forex market to set the scene. Then we'll break down the three massive strikes that hit the CAD, the oil price crash, the widening policy interest gap, and finally, those looming tariff threats. And we'll wrap up by looking at what the future actually holds for the loonie. All right, let's start with part one, Forex market weekly overview, also known as the scene of the crime. When we look at how major currencies performed over the last 5 days, the pattern is impossible to ignore. We've got massive US dollar strength up against universal weakness basically everywhere else. The US dollar just kept marching upwards, soaking up all those safe haven flows and riding high on economic resilience. But then, on the complete opposite end of the spectrum, you have the Canadian dollar totally falling off a cliff. It was, without a doubt, the absolute weakest link in the market this week. And the hard data totally backs up what we're seeing visually. The CAD's strength rating literally tanked. It started at 28 points on Monday and bled out to a bleak 7 points by Friday. It just completely bottomed out by the end of the week. This sets up an extreme contrast. On one side, you have the US dollar surging by 15% week over week, literally the only major currency to see a single direction rise. On the other side, a devastating 75% drop in overall strength for the loonie. It's a massive swing. So how exactly did it lose so much ground so fast? That brings us to part two, strike one, the oil price crash. Let's play financial detective and look at the first structural pillar that just totally gave way. To really get this, we have to remember that the Canadian dollar is your classic commodity currency. Because Canada relies so heavily on energy exports, the loonie and crude oil are essentially tied together on a very short leash. When oil prices drop, the underlying baseline support for the Canadian dollar just completely vanishes. And man, it was just a rapid-fire succession of bad news for energy markets this week. It kicked off on June 3rd when OPEC Plus actually lowered their global demand growth forecast. Then, literally the next day, the U.S. reported a massive, unexpected jump in commercial crude inventories. We're talking 5.2 million barrels added when the market was bracing for a decrease. So by June 5th, all these weak demand signals pushed WTI crude well below $71 a barrel. All of that culminated in a greater than 8% drop for crude oil in a single week. It went straight from $78 a barrel down to below $71. Now, if you're a commodity currency, watching your core export drop more than 8% in just a few days, that instantly wipes out your fundamental support. Strike one. Now for part three, strike two, the policy interest gap. This hit came directly from the central banks, where we are seeing a massive divergence in monetary policies start to take shape. Just compare the US and Canada right now. It is night and day. In the US, strong jobs and services data keep rolling in, which is really cooling off any hopes for a rate cut. Heck, some people are even whispering about potential rate hikes. But up in Canada, May's CPI actually dropped to 2.1%. Because inflation is cooling there, the market is suddenly pricing in a whopping 70% probability of a July rate cut. And that divergence was completely solidified by Bank of Canada Governor Tiff Macklem. He came out and said, if core inflation continues to ease, there is reason to begin cutting interest rates this year. That is a massive pivot from his previous super hawkish tone. Think about it. From an investor's perspective, when you see U.S. rates staying high and Canadian rates getting ready to drop, it acts like a giant magnet. That policy gap just accelerated capital flight right out of Canada and straight into the US dollar. Next up is part four, strike three, tariff threats. The final blow to the Canadian dollar didn't actually come from commodities or central banks. It came from rising geopolitical trade friction. Canada's vulnerability to U.S. trade policy is pretty staggering when you look at the numbers. Over 70% of Canada's total exports head right across the border to the U.S. That accounts for more than 30% of Canada's entire GDP. So when reports started coming out on June 5th that the U.S. is considering tariffs on Canadian steel and aluminum over claims of unfair competition, it was a gut punch to Canada's manufacturing outlook. It injected a huge dose of external risk right into the market. So this wasn't just one bad day or one bad data point. It was a perfect storm. Crashing commodities knocked out the baseline support. Widening interest rate expectations sucked capital away to the safety of the US dollar. And sudden trade friction completely shattered market confidence. You put those three converging forces together, and the CAD honestly had absolutely no room to rebound. Finally, Part 5, the future of the loonie. With the CAD ending the week scraping the absolute bottom, what's going to dictate its next move? If you're investing, there are three main things you need to monitor, matching up perfectly with our three strikes. First, keep an eye on oil. You're looking for WTI to stabilize and watching for any adjustments from OPEC+. Second, watch the central banks. The upcoming Bank of Canada rate decision and whatever signals the US Fed gives will dictate how wide that policy gap gets. And third, track trade. We have to see if these US tariff threats actually turn into concrete policy. Which leaves us with this incredible, high-stakes balancing act for next week. Canada is hitting its inflation targets, so a rate cut technically makes sense. But here is the billion-dollar question. With the currency already in free fall, will the Bank of Canada really dare to pull the trigger on a rate cut and risk sinking the loonie to dangerous new lows? The entire Forex market is holding its breath right now to see who blinks first. We'll be watching the data closely, and you should too, because next week might just rewrite the charts all over again.